The market just fell 30%. Your phone is showing you a red portfolio. The news is using words like crash, collapse, and crisis. Everyone around you seems to be doing something: selling, switching, moving to cash, talking about waiting it out. And you are sitting there thinking, what am I supposed to do? Here is the answer, step by step, in order. Spoiler: the most important step is probably not what you expect. Welcome to Freelancer Retirement Lab. With personal finance experience and the parent of a freelance creator, this channel exists to give the freelance community the financial education they deserve. Subscribe. New videos every Tuesday, Thursday, and Saturday. Step 0. Check the foundation first. Before you do anything with your investment account, check something else first. Your foundation. Is your tax reserve account funded? Does it cover the next quarterly payment? Is your business reserve healthy? At least a month of your income floor sitting there. Is your emergency fund intact? 6 to 12 months of essential expenses? Here is the insight that changes how a market crash feels. If your foundation is solid, a 30% market drop is a completely different experience than if it is not. With the foundation in place, your actual daily life is completely unaffected. You can watch the market fall and feel almost nothing, because you do not need that money. It is the long-term account. Without the foundation, every red day feels like a genuine emergency, because it might be one. The foundation does not just protect your money, it protects your psychology during the moments when your psychology is most likely to cost you money. If your foundation is thin right now, that is priority 1. Not the investment account. The foundation first. Step 1. Do nothing. Seriously, nothing. Okay, foundation is solid. Now what? Nothing. Do not sell. Do not switch funds. Do not reduce contributions. Do not move to cash. I know that sounds passive. It feels passive. Everything about the current moment is telling you to move. But here's the thing about movement during a market decline. The action that feels most responsible is statistically the most destructive. In March 2009, the absolute bottom of the 2008 financial crisis, investors had pulled $230 billion out of equity funds. That was the moment of maximum action. Maximum doing something. It was also the cheapest stocks had been in a generation, and the market went on to rally over 400% in the following decade. The people who acted missed it. The people who did nothing captured it. Do nothing with your investment account. That is step 1. Step 2. Keep the automatic contribution running. Step 2 feels small. It is not. Log into your account and confirm your automatic monthly purchase is still scheduled. Do not pause it. Here is why this matters more than it seems. If the market has fallen 30%, your regular $500 monthly contribution is buying approximately 43% more shares than it was at the previous peak. Your money is not buying less. It is buying more. The market just went on sale. Your automatic contribution is filling a cart at 30% off. That is dollar cost averaging, working exactly as it was designed to work. If cash flow is genuinely tight during the downturn, a slow month, a delayed payment, reduce the amount. Do not stop it entirely. $200 keeps the habit, the accumulation, and the compounding running. Even a small, consistent purchase during a decline is meaningfully better than nothing. Step 3. Consider adding more if you can now. If your foundation is solid and you have surplus cash above your income floor, this is when I want you to think differently about what a market decline actually is. It is a sale. A 30% decline on VTI is the entire U.S. stock market. 3,600 companies, available at 30% below what they were worth 3 months ago. The businesses are still operating. The revenue is still coming in. The long-term trajectory has not changed. The price has changed, temporarily. The investor who adds cash during a market decline is not brave. They are just applying the same logic they would to any purchase. Buy more when something you want is cheaper. One condition: This money must be genuine surplus, not the emergency fund, not the tax reserve, not anything you could conceivably need in the next 5 years. Only money you can leave untouched until the recovery. Step 4. Do one mechanical thing. Rebalance. Step 4 is the one active investment decision a passive investor makes during a decline. Check your allocation. If you started at 80% stocks and 20% international, the decline may have shifted those ratios because different assets fall by different amounts. Maybe you are now at 75 and 25. Rebalance back to your original targets. Sell a small amount of the overweight. Buy a small amount of the underweight. This is not a gut feeling. It is mechanical. It is following a written plan made when your emotions were calm. And inside your solo 401k, there is zero tax on any of this movement. Rebalancing during a decline means you are automatically buying more of whatever fell the most, which positions you to capture more of the recovery when it comes. Step 5. Turn off the news. Step 5 is probably the most practically important of all. Turn off the financial news. I mean this seriously. Financial news is not designed to help you make better decisions. It is designed to keep you engaged. Fear and urgency are more engaging than calm and patience. The language of market coverage during a decline, crash, crisis, collapse, recession warning, is optimized for eyeballs, not for your wealth. Research consistently shows that investors who consume more financial media during downturns make worse decisions than those who disengage. Your investment policy statement, the one-page document you wrote when calm, contains everything you need. That document says, hold, keep contributing, rebalance mechanically, do not sell. The news says, this time is different. It almost never is. The number that reframes everything. Here is the calculation that I want you to carry with you. A freelancer at age 35 with a $100,000 portfolio. Market falls 30%. Balance, $70,000. If they hold and keep contributing $500 per month through the decline and recovery, at 7% average annual return over the next 25 years. Final balance at 60, approximately $624,000. If they sell at the bottom, move to cash, and wait until it feels safe to reinvest, missing 12 months of recovery gains. Final balance at 60, approximately $558,000. The decision to do nothing during a 30% decline was worth $66,000. Over 25 years, doing nothing is one of the most financially productive decisions available. When the market falls 30%, check your foundation. Do nothing with investments. Keep contributions running. Consider adding surplus cash. Rebalance mechanically. Turn off the news. That is the complete plan. 5 steps, built from 100 years of market data. The investor executing this plan is not passive. They are doing exactly the right thing, at the moment when doing the right thing is hardest. Have you ever been through a market decline? What did you do at the time? Drop it in the comments. I want to know. If this gave you a plan you can actually follow, tap the like. It takes 1 second and tells me you want more of this. See you on Saturday.